to our webinar this afternoon, After Wayfair and Tax Reform, What We've Learned. Today, this afternoon's webinar will be presented by Tom Mao and Shane Finn, who are part of our experts at Stambaugh here. Just a few housekeeping items before I pass it off to them. We do have a handout available in the GoToWebinar pane for download. You can follow along with Shane and Tom as they go through this presentation this afternoon. Any questions that you may have, please put them into the questions panel of the GoToWebinar platform, as we do not monitor the chat box. And we are offering 1 CPE credit this afternoon. There are a couple steps that you need to do in order to receive this credit. We will have 3 polling questions throughout the webinar. We just ask that you answer them as quickly as possible, so then Tom and Shane can get through their webinar this afternoon within the hour that we have allotted. And also, to request that CPE certificate, in addition to answering the polls, we just ask that you fill out a quick survey at the end indicating that you actually do need the 1 CPE credit, because without that survey answer, our system will not generate that to you. So without further ado, I'm going to pass it off to you, Tom.
Thank you, Kaylee, and hello, everyone. Thank you for joining us this afternoon. I know we have a nice big group joining today, interested in hearing about what's going on the tax front. Certainly on the tax reform front, that's going to be more federal focused, but the Wayfair is certainly going to then shift it over to the state. So I'm going to handle the tax reform part of this to get us going, and then hand it off to Shane to wrap up the webinar a little bit later this afternoon. Certainly our title sounds like we're looking in the rearview mirror a little bit, what we've learned. And I think it is important that we do get some context of what did happen, especially in 2018. But really what our focus here today is, how do we take those lessons and how do we look out the front windshield and be a word that we use at Stambaugh is not proactive, but preactive. I don't know if we made that word up or not, but we think that means a little bit more than just the historical definition of proactive. We're really trying to be anticipatory and say what is coming down the road in the near term as well as the long term, and how do we use that knowledge to our advantage to do the best planning and the best bang for the buck we possibly can in a somewhat uncertain world of federal and state taxes. So certainly 2018 was a year of historic change. On the federal side, as you're well aware, the Tax Cuts and Jobs Act was signed into law by President Trump in December of 2017, with most of those provisions becoming effective in 2018. This was a huge piece of tax legislation, the most significant tax legislation we had since the Tax Reform Act of 1986, and certainly was controversial at its passage, and that has not changed since then. There are many proponents of the bill. It's generally taxpayer friendly, but it's coming at a huge cost to our national deficit and so on. The bill passed almost strictly along party lines. Even a few Republicans did not vote for it. I think that's important to note as we're entering into another election season in 2020. Most of the individual passage tax provisions in the law will expire after 2025 because that was necessary to get the bill passed. It would have taken some Democrat votes if the bill cost more than $1.5 trillion. So that certainly has impact. Certainly also to pay for the bill, it's not all good news. There are certainly some provisions in here that will cost taxes as well. So we want to just review some of the big provisions in that and bring some awareness to you today and what we can do about that. On the state side, which Shane will get into a little later, we also had something extremely monumental in 2018. In June of 2018, the U.S. Supreme Court ruled in favor of South Dakota in the South Dakota versus Wayfair Act. And I'm not going to get into a lot of the details on that now. Shane will later, but it really changed the whole platform of who is responsible for charging, collecting, and remitting sales tax as we sell our product across state lines. We just want to bring attention to you as well that you may think this is only something for online retailers, the Wayfairs, the Amazons of the world. Certainly it was aimed at them, but we think it encompasses a much broader population of companies, and quite possibly your company as well. So let's get started on the federal side, the Tax Cuts and Job Act. What did we learn, and what are we going to do with that here in 2019? But before we get too deep into that, we'll start with our first polling question. Kaylee's going to go ahead and launch now, and we just want to get a feel for who is in our audience today, what type of entity your company is, how are you organized for tax purposes. Are you a C corporation, an S corporation, a partnership, or a sole proprietorship? Or we do have other there. I'm not sure what other might be, but if you don't fit in one of those categories, let us know. So Kaylee, when we've got a sufficient response there, let us know what the results are.
Sure thing, Tom. So I'm going to go ahead and close it out, as we do have 85% of our audience who have already participated. I will close and share the results with everybody. So 36% is a C corporation. In the lead is an S corporation with 49%. We do have 7% of the audience that is a partnership. 0% are actually sole proprietorship, and 7% actually did answer other.
Okay, so good. So predominantly we have C corporations and S corporations that are in midst today, but certainly for those of you that are partnerships, we have some relevant comments as well. So where did the Tax Cuts and Job Act start? Well, it really started with tax rate changes. The rates got a lot of the attention. There's a whole lot more to it than that, but the rates are a very good place to start. And for those 36% of you that are C corporations, you're probably well aware that you got a pretty nice tax break in 2018. C corporation rates before 2018 were graduated rates which worked their way up from a low of 15% to a high of 35%. Now it's a flat rate of 21% across the board. So for most, but not all, corporations, a nice break. Now that 35% rate's a little bit of a misnomer, that unless you were a personal service company, you only hit the 35% rate when your income went over, taxable income went over $10 million. However, there was a 34% rate that you hit at a much lower threshold, as low as $100,000 of taxable income. So whether it was 34 or 35, you got a nice break going down to 21%. Now the reason we say personal service companies are the big winners is because a personal service company, which if you don't know, that's a type of business that really doesn't have a tangible product that really provides services. We as accountants fall into that category, as do attorneys, financial advisors, architects, engineers, and you know, businesses like that. For whatever reason, historically, personal service companies never got the benefit of the lower tax rates if they were formed as a C corporation. They paid tax on their income from $1 at 35%. And that caused most personal service companies that were C Corps to do all kinds of planning at year end, you know, to make that income go away. If you were a cash basis taxpayer, pay every account payable that you have in the door in December, maybe slow down billing to slow down receipts and so on, because you sure didn't want to pay 35% flat federal taxes and then have a state tax liability on top of that. Well, this is a big differential for those firms that now that's capped at 21%. On the individual side, we also saw tax rates decrease, maybe not quite as extreme. We had 7 brackets before. We still have 7 brackets, but within those brackets are lower rate brackets and also an expansion of how much income is taxed at the lower rate. Now, the top rate itself didn't fall a whole lot, 39.6 to 37%. But what you're looking at here is what those tables will look like for 2019. They are adjusted for inflation each year, so the 2019 rates do expand even a little bit more on 2018. And you can see to hit that 37% bracket, you have to have fairly significant taxable income. On a married filing joint return, only your income in excess of $612,350 is subject to tax at 37%. And each of those brackets before give you some nice savings. The 12% bracket, the 22, the 24, and even the 32 were new brackets introduced in 2018, where the corresponding bracket previously was a higher rate, and it would have kicked in at a lower number. So I think it's safe to say that the same amount of taxable income in 2018 and again in 2019 certainly yields a fairly significantly lower amount of tax than it did prior to 2018. Now, if it were only that simple, and it's not, because a lot of other provisions in how you get the taxable income changed, and we'll talk about that. But even with that, remember, I'm paying tax as a C corporation at 21% from $1. And you can kind of do the math in these brackets and say, well, where does my blended rate go over 21%? Well, it's not a real high number. So, gee, maybe I should consider switching to C corporation. Well, Congress, realizing that, introduced another concept, something called Code Section 199A, that just being the new Internal Revenue Code that describes this provision. And what it's really all about is something called qualified business income. And this was meant to somewhat level the playing field between the corporate rates and the individual rates. So if you are an S corporation or a partnership, I don't think we have any sole proprietorships with us, but if you are, and even for some entities that you may have on your personal return, like rental properties, Section 199A, if you qualify, allows you to exclude up to 20% of the income from that entity from tax. So that sounds pretty simple. If it only was, and we're going to get into some of the limitations and rules. And I can't go deep enough today to make you really understand it. I just want to give you awareness that 199A is very complex. In my many years in the profession, I think it's one of the most complex provisions that I've ever seen. It's powerful if you use it, and that complexity does give us some planning opportunities. So in its simplest form, we make $100,000 of income, we exclude 20% of that, and we only pay tax on 80%. So even if our total income is in that 37% tax bracket, if we can exclude 80% of this income from tax, well, that makes our effective rate about 29.6%, 80% of 37. Well, what's this all about? Well, what is qualified business income? Well, this concept is not that difficult to understand. It's really all of the income and losses deductions that the entity throws off, except for income that would be classified as investment income. And investment income is typically dividends, interest, capital gains, the use of your excess cash in the corporation. It does include the bottom line on your Schedule C if you're a sole proprietorship. It does include your net income from rental activities if you meet certain criteria. Now, again, rental has been subject to a lot of debate. We've had regs come out. We've had interpretations come out. If you have rental income, we need to talk a little bit further with your professional advisor to make sure that income does qualify for the deduction. And if it doesn't, are there any things you can change to make it qualify? Typically, if you have a triple net lease, that's not going to qualify because you're not taking a terribly active role in running that activity, so it's not going to meet the definition of a qualified business. What QBI, or qualified business income, does not include are wages. So if you're an S corporation and you made $300,000 before paying your owners, and then you paid your owners a salary of $150,000, your QBI is going to be net of that compensation, or $150,000. You can only exclude 20% of the $150, not the full $300. You might be thinking ahead with me and saying, well, that's a planning opportunity for me, and it sure is. Partnership guaranteed payments as well, kind of the equivalent of shareholder salaries in a partnership, also do not count. Again, if it was only that simple that we could come to that number and say, well, 20% of that is my deduction. Well, there's a little bit more to it. If our income goes over certain levels, and remember, this is measured at the individual level, not at the entity level. So if I'm a stockholder in an S corporation and my taxable income on a married filing joint return is over $321,400 or $167,000 on a single return, I need to look at some additional limitations to determine whether I can take the full deduction. If I'm under that amount, and I have sufficient taxable income, I'm generally going to get a 20% deduction. If I'm over 421,400 or 210,700, the limitations are in full application. If I'm in between those two thresholds, there's a phase-in, and I can tell you the phase-ins are some of the most complex calculations you'll ever see. So what are these limitations? Well, first of all, we first have to look at, did the entity pay sufficient wages? And when I say sufficient wages, it's what is the total W-2 wages paid by the entity to all employees, including the owners, times my particular ownership percentage. So if I paid $1 million of total wages and I own 50% of the company, my allocation is $500,000. Is that $500,000 more or less than 20% of the income the entity threw off? If it is less, my deduction is limited to 50% of the wages. Well, that raises an issue. I've been talking about these rental properties. Well, rental properties usually don't have any wages. So how am I going to get a deduction if 50% of zero is zero? Well, recognizing that, a provision was put in that I have an alternative calculation that says I can take 25% of the W-2 wages, which again still may be zero, but I can add to that 2.5% of something called UBIA, or the unadjusted basis of qualified property. Again, that's a mouthful and probably doesn't mean much to most of you listening, but what it really says is, what was my original cost of my depreciable assets, my equipment, my buildings, my leasehold improvements? Are they fully depreciated yet or not? If they're not fully depreciated, or in the case of equipment, I haven't had them in play for 10 years, I can take the total of that number times 2.5% and compare that to my income and take, again, what would be the lesser of the deductions. So I'm sure with all of that, I've probably really confused you, and we don't have time to really work through some examples, but just be known that you really need to be, again, here's that word, proactive, looking ahead to what might my income be. Are there things I can do to plan around this? Now, there's one more level of limitation if I am something called a specified service trader business. This is kind of the equivalent of the professional service corporations I described earlier, but now it's not at the C corporation level where these type of businesses are being penalized. It's at the pass-through level as such a C corporation or a partnership. Now, for our friends that are out there today who are architects and engineers, you guys have some great lobbyists. They were able to get architecture and engineering exempted from this limitation. So architects and engineers do not meet the definition of specified service trader business for this provision, and that was a huge win for that industry. But if you're an accountant, an attorney, a financial advisor, and you can see other, a doctor, unfortunately, if your qualified business income is over those thresholds we looked at before, 321,400 to start the phase out, 421,400 for the full phase out, you are not allowed to use this provision at all. You will get, well, between 321 and 421, you'll get a partial phase out of it, but over 421, you will not be able to use this provision. Is that fair or not? Well, we can all make our judgment on that, but I guess we'll just say it is what it is, and we have to plan around it. So a couple of final notes on 199A before we talk about what we can do for planning. Again, as I mentioned earlier, the calculation is done activity by activity. So if you own multiple entities, you determine your qualified business income for each, but then that comes through to you at your personal return and you net them together. If there's a loss from one, you have to offset the income from the other, which will reduce your deduction. If it's a net loss, that loss will carry over and it'll offset future year's income. Now that sounds like a positive. Usually we like to use deductions in the future year. But here, remember, we maximize our benefit by taking 20% of the income. So, the lower the income here, the less our deduction will be. Still a lot of confusion with rental activities. They really need to be looked at on a case-by-case basis to determine if they're going to qualify. And our last bullet point there is Section 199 comes after your adjusted gross income on your tax return. Adjusted gross income, which is basically the sum of all your income from all sources, whether that's wages, business, investment income, minus just a few deductions, that number is often used to determine if you can get certain credits or other deductions. The higher the number, the less benefit you get. Well, the Section 199A deduction comes after adjusted gross income, so it is not going to help you lower that threshold to benefit from many other provisions. So what can we do to plan and utilize 199A to the best of our ability? Well, depending on our circumstance, we may want to either maximize or minimize taxable income. And you'll hear me say this oftentimes. There's not a cookie cutter answer for each of you in the audience. We all have to look at our own individual situation. So say I am a specified service trader business. I'm an attorney working in a law firm, and I think I'm going to be right around that phase out threshold of income. Well, I may want to move my income down because it's an all or nothing proposition. So we may want to enhance retirement plan contributions or employee bonuses to move under that threshold amount. I really like the retirement plan contribution option because even if you're a cash basis taxpayer, you can deduct your retirement plan contributions in full as long as they're paid by the due date of your tax return. Well, if you extend your tax return, you could potentially have till September 15th of the following year to not only make that contribution, but also to really have a good handle on where your taxable income is and know how much you need to fund to get the maximum benefit. Now, if you're not a specified service business, you may want to accelerate your income to take even more advantage of this threshold. So you may look at your depreciation. You may say, even though I've got some really nice accelerated depreciation available to me, do I want to use it or not? Do I want to save that for later? Remember, Section 199A, like all the other individual provisions, expires after 2025. And depending what happens in next year's election, if a different administration comes in, we don't know that they won't disappear as early as 2021. So we kind of have to read the tea leaves a little bit on that. Remember I said earlier, stockholder wages will reduce qualified business income. Well, what if I decrease the wages paid to the stockholder in my S corporation, but instead provide them with an after-tax distribution? Well, that'll work, but I say exercise extreme caution in that strategy because the IRS loves to look at S corporations and make sure the owners are being paid reasonable compensation in regards to the duties they're doing, their responsibilities within the entity, and market salaries for what their position is. So don't get carried away on that one. Certainly don't eliminate stockholder wages. But if the wages are already on the high end, there may be some room there. With partnerships, we think there's a little bit more flexibility with guaranteed payments, replacing guaranteed payments with special distributions. Guaranteed payments don't seem to get the same level of scrutiny that S corporation wages do. So we can either increase or decrease those amounts depending upon what we are trying to accomplish with either more or less income. And there's certainly all the traditional techniques we've always had for deferring or accelerating income and expenses, such as paying down accounts payable, buying new equipment, and such. So again, I don't have a one-size-fits-all answer for you here. My answer is, let's look at what not only maximizes your benefit in the current year, but what impact will that have in future years? So we still come down to that question of, well, should I switch to C corporation from S corporation? That's all great that I get this 20% deduction. But this is really complicated. I don't have to deal with this as a C corporation, and I still get that 21% rate. Well, you do, but what is your effective individual income tax rate? Your top rate might be 25%. It might be 32%. But when you take into account the impact of those lower brackets, is your effective rate more than 21%? Remember, in a C corporation, if you do want to distribute the profits at a later date, you will be taxed on them. So it's a second layer of taxation. So again, that depends on the entity. If you're not one that usually distributes profits, you reinvest it in the company, maybe C corporation makes sense. Remember, those distributions also have another tax, the net investment income tax. That's a 3.8% tax on top of your income tax. Many states have different rate differentials. I'm in Pennsylvania. Pennsylvania's C corporation rate is 9.99%. The individual rate's only 3.07%. So, that offsets some of that differential as well. And you can see a couple of other bullet points there. So back to my original point, look at each situation individually and do a thorough analysis. Well, how long are these rates going to last? Well, we don't know. We know the corporate rates are supposed to be permanent, but they've gotten a lot of criticism from the other side of the aisle, and they would like nothing better than to drive that 21% back up to a higher rate. We know the individual rates, including Section 199A, are scheduled to expire. What will happen if there's a change in the presidency in 2020? So maybe depending on how you feel about that, we do what we would call reverse tax planning and accelerate income into 2019 and 2020 to take advantage of those lower rates and save our deductions for later. That's a risky proposition. We know what we have in 2019 and 2020. We know if we maximize these benefits, we have cash in hand. I just heard a story yesterday that was a strategy a lot of folks were taking back in 2007, 2008, when President Obama came into office. They were trying to pay tax because they anticipated higher rates. Well, what happened then is we had the recession of 2008 and 2009, and those higher rates actually never came to fruition. So if you're like me, I like to take advantage of what's known. I probably wouldn't do the reverse tax planning, but it is something you should talk about on a case by case. Well, if it was only rates, we'd be done, but there's a lot of other things that give us opportunity within not only business but individual planning. But we're going to pause here and do our second polling question. It's a pretty simple one. Just flat out, does your company's annual gross receipts, are they less than $25 million a year, or are they more than $25 million a year?
All right, I'm going to go ahead and close this poll.
Okay.
And 64% said yes, and 36% said no, Tom.
Okay, thanks, Kaylee. And again, pretty good mix. And you're going to see in the next two slides, I have good news for you if you're under 25. I have kind of bad news for you if you're over 25, but we can turn that bad news into a positive, I think. So if you're under $25 million in average gross receipts, the IRS now considers you a quote-unquote small taxpayer. And what's important to that is you are now able to use the overall cash method of accounting. You no longer have a requirement to keep inventories if you did before, and you're also not subject to the very complicated uniform capitalization of inventory rules that we had before. And we want to go into detail on those, but what I can say is they generally drove up your taxable income. So why is this important? Well, remember, inventory and capitalizing inventory delays the deduction of your cost, of your production cost. So now, as we buy our raw materials, as we pay our wages, as we pay our overhead, we can deduct it immediately. In the cash method of accounting, we pay tax when the money is received from our customer, and we get a deduction when we make the payment of our vendor payments. So we have much more control. So all of those profits we have sitting on our books, if we're an accrual basis taxpayer, those accounts receivable that we've already paid tax upon, but we didn't receive the cash, now reverses itself. And we don't have to pay money, we don't have to pay tax on that money till it's received. If you're a contractor and you're under 25%, you no longer use the percentage of completion method. We saw a lot of small manufacturers make this election in 2018, and the savings were quite significant. that year of election is a big windfall for you. Because you're going to delay paying tax on the net receivables over payables that are on the books at the end of the year, and you might even pay down some of those payables to get some more deductions. And even after the windfall in year one, you have a lot more flexibility to control future taxable income. It may even create losses that we can carry forward to future years. So again, but if we do create a loss, it will reduce your Section 199A deduction. So we want to model all that out and see what the impact of that is. And maybe, just maybe, if we do think higher tax rates are coming, we delay making this cash basis election until the higher rates come. So again, a little bit of a timing question there. Now, if you are over 25 million, you're going to be faced, and you were faced in 2018, with a limitation on the interest expense you can deduct. It's basically a calculation of you can't deduct interest expense which exceeds 30% of your adjusted taxable income, and that's your taxable income with add backs such as depreciation, amortization, interest, and taxes. Unless you're highly leveraged, it may not be an issue to you. But if you're a growing entity and you're over $25 million, you at least have to do these computations, and they are complex. And if you're taking a deduction away, that generally would be viewed as a negative. But again, you don't lose the deduction, you carry it forward to a future time when you meet the credit, the calculation that would get you under 30%. So again, maybe you're saving deductions for a higher rate in the future. Now again, I say that certainly the cash basis rules and the interest deduction rules are not immune from change as well. So we have to keep kind of reading the tea leaves to see where that goes. But we know we have these provisions in place for 2019. We know we have them for 2020, and we can utilize them. Certainly depreciation had lots of changes. Under the Code Section 179, we used to be able to deduct the first $1 million of assets we purchased each year. Much more lucrative now, we can deduct 2.5 million plus. It was 2.5 million in 2018. It gets indexed for inflation each year. Even better is the expansion of something called bonus depreciation. We used to be able to take 50% in the first year of only new equipment. Well, now that is 100% up to the end of 2022 for not only new but used equipment as well. So we don't have to utilize bonus depreciation if we want to save our deductions, but we now have that flexibility if we're an expanding entity to deduct all of our personal property. And when I say personal property, that doesn't include real estate. So if you're building a building, it doesn't include that. That still has to be depreciated over 39 years. But if you do have a building project, whether that's new construction or renovating real estate, there's something called a cost segregation study that can be done that might move some of that cost into shorter lived depreciation classes, which then again will give you that bonus expansion. There's probably nothing else more flexible than the use of the bonus depreciation. Certainly, since many of you are S corporations and many of you are partnerships, we have to think about what went on at the individual level as well. And as we said before, what's going on at the individual level, don't get used to it. It's set to expire, if not before, in 2025. But what are some key things here? Well, number one, we lost the ability to deduct personal exemptions. We used to get $4,050 a person for everyone we claimed in the tax return, husband, wife, and all the dependent kids. Well, if you were in a 25% tax bracket, you lost about $1,000 per person. But what replaced that was an expansion of the child tax credit. Prior to 2018, we could get a credit. Remember, a credit offsets taxes dollar for dollar for each qualifying child under the age of 17. But if our income was over $110,000, we totally lost the credit. Well, under the new act, we don't lose the credit now until our income goes over $400,000 on a joint return, and the credit's been expanded to $2,000 a child. So if we are a family of 4, 2 kids, and we lost $2,000 as a result of the, $4,000 as a result of the loss of our exemptions, 16,000 times 25%. Well, we picked it back up here. under this provision. But what if our kids are in high school or college? They're not under age 17. We still lost the exemptions, but we didn't pick up the credit. So again, person by person differences, and certainly if we're around that $400,000 phase out, we might want to do things to manage our taxable income to get it down lower, some of the things we already talked about. We also saw a big change as it relates to standard deductions versus itemized deductions. Previously, we would get a standard deduction if we were a married filing joint return in the ballpark of about $12,000, about $6,000 on a single return. Well, generally, those deductions have been doubled under the new Tax Act, and they are expanded for inflation each year. Well, what that means is we take the greater of our standard deduction each year or our itemized deductions. Well, for most homeowners, paying down a mortgage, paying real estate taxes, typically the itemized deductions, which not only include real estate taxes and mortgage interest, but your state and local income taxes, charitable contributions, employee job expenses, often that well exceeded the standard deduction. Well, not only do we have a higher standard deduction now, the itemized deductions have been hit pretty hard with some significant changes. One of the biggest ones is in the form of state and local taxes, which now include not only your income taxes, and some of you may be in high income tax states, you know, the New Yorks, Illinois, Californias of the world. You may also have some pretty high real estate taxes. No matter what that total number is, we can't deduct more than $10,000 in total. There's also some limitations now on how much mortgage interest we can take depending on the original indebtedness of our home. There's been some slight changes to charitable contributions. And the entire miscellaneous itemized deduction category, employee business expenses. If you're a salesperson, you may have significant items there. You may have an office and home. You may have vehicle expenses. Your investment expenses, your tax prep fees, your union dues are no longer deductible at all. So with that being the case, if I'm a married filing joint return and I'm getting $24,400 of standard deduction this year, I may not be able to reach that level at an itemized deduction. So I'm just going to take the 24.4, whereas before my itemized deductions may have been well in excess of that number, but with the limitations of what I can deduct, I've lost some net deductions there. Well, if you're close to that threshold on a year by year and you're just missing it, you can do some strategies that we call things like bunching. If you have control of your medical expenses, whether it's eyeglasses or things like that, dental, maybe delay into the next year. Certainly with charitable contributions, rather than giving to that same charity year over year, maybe you double the deduction every other year. And one year take advantage of the full standard deduction. The next year get a little bit in excess of that with the itemized, just to get that incremental increase. If you're a retired person who's drawing from an IRA and you're required to take distributions and pay tax on them, you can actually, instead of taking that money yourself, if you can't itemize, send it directly to a charity, and you can avoid paying tax on those dollars. If you have significant capital gains, maybe you sold your business this year, or you sold a significant piece of real estate, there's a really powerful planning tool called the Qualified Opportunity Zone. A really, really complex area. To get the full benefits, you have to invest by December 31 of this year. But basically what a Qualified Opportunity Zone does is it moves your money into an investment in an economically depressed region. It could be somewhere close to your community that your state has designated. You not only get to reduce, if you hold the investment long enough, your existing capital gains, but also not pay tax on the appreciation of that new property. If you have significant capital gains, I'd advise that you get a little bit more information on this. We could probably talk for an hour easily just on this topic, but it is a powerful way to defer your taxes there. The alternative minimum tax was an area that President Trump wanted to do away with altogether. It's been a boon to taxpayers, or it's been a thorn in taxpayers' side for quite some time. Most people don't understand it. They just know they get hit with this thing and have to pay additional taxes. Well, what alternative tax is just what it says. calculate your tax the regular way, and then calculate it another way. And if that number is higher, pay the higher amount. Well, we did get some relief in the Tax Act. We couldn't get rid of it entirely, but the exemptions are higher. The phase-outs of the exemptions are higher. So we saw a lot less people subject to alternative minimum tax in 2018. That opens up the door for using some other credits and some other deductions. There are certain credits that are phased out if you're subject to the alternative minimum tax, such as the research and development tax credit if you're a larger entity. Maybe some opportunities there to utilize things you couldn't use before if you're in that category. And just 2 more slides here before I turn it over to Shane. If you have children who are attending private schools, private K-12 schools, you can now use 529 plan money to pay for those expenses. So if they're young children and you think they're going to be going to private school, if you put some money away, it will grow tax-free until the time you withdraw it. You can take $10,000 a year out for those expenses. Previously, you could only use 529 money for higher education. And last but not least are Roth IRAs. Roth IRAs, I think we all know what they are. They're the ability to put money in an IRA that grows tax-free forever, or until we take it out. But if we have traditional IRAs where we got a tax deduction previously for putting the money in, we can only get it to a Roth by paying tax on the current value of that IRA and then letting it grow tax-free from there. Well, our current low tax rate environment may lead us to this is a really good time to convert your traditional IRAs to Roths. And if they're of such that, it'll throw you into a higher tax bracket, you can time that. Take 50% this year, 50% next year. And then once you're in a Roth, there are some ways, a method we call the backdoor conversion, to continue adding to those Roths as we go forward. So that was a lot on federal tax reform. Just the key points there. Every situation is different. You need to work with your professionals to work through your situation. Build on what you learned last year and the actual results, but don't plan in a vacuum. Think about the impact this year and in future years. If we have to sacrifice a little bit of savings in 2019 for the good of the long term, I think that's wise tax planning. And certainly don't overlook the impact on the states. And with that, that's a good lead-in to kick it over to Shane, who's not going to talk about state income taxes, but he's going to talk about what we've learned with South Dakota versus Wayfair. So Shane, I'm ready to take a break. It's all yours.
Thank you so much, Tom. And very similar to what you discussed, a major event in 2018 is what we're going to focus on today, the South Dakota versus Wayfair United States Supreme Court case. Not just discuss and summarize, probably fairly brief due to the time constraint, but summarize the case, the who, what, where, when, why, but then also what has the last year and a half, the last year from the case, what unfolded from them, and how to be proactive when you're doing your tax planning. So we can go into the South Dakota versus Wayfair. So the impact of the Supreme Court decision, it's been a year now since it's been handed down, and again, it's sending major shockwaves throughout the business world, throughout the tax world. So it's not just you as a business owner, the professional service providers themselves are also getting a daily headache from a new state update. So as the year continues to wear on and then into 2020, this decision definitely carries implications for industry just beyond the retail, the online e-commerce type sales functions. It actually goes to very basic functions to any business that has multi-state operations. And if you're not understanding these implications and stay up to date with the changes, it can definitely have significant financial consequences, along with the failure to collect the sales taxes and all the nasty penalties and interest that can accumulate over time. So we recommended, your business management, along with your tax advisor, your CPA, your tax attorney, definitely be assessing your potential sales and use tax exposures in light of the Wayfair decision. It can be done on a monthly, quarterly, biannually, definitely annually. We recommend you revisit the sales to your out-of-state customers. and then managing the fallout themselves from Wayfair, you really need to understand not only your business, but how do the states look at your business. So the definitions, the tax statutes, they may define things a little differently than what you may think as the business owner. So as we continue to digest the Wayfair decision and all the implications, like Tom said, this is state sales tax, but there are some income tax, gross receipts tax, other types of taxes that may have had some of this fallout that we'll touch on briefly here in a few slides. And also not to be overlooked, and something I like to highlight in any kind of merger and acquisition activity, this Wayfair decision has certainly brought that to light as the due diligence firms on the buy side and the private equity firms have state and local tax compliance as part of their routine checklist. So again, anything with taxes, sometimes they may seem straightforward, but as you know, they can be very complex, even though the states are generally the same, similar, I should say. Just be aware and do due diligence, do research in every new state that you're entering as the years go on. So for our first slide here, North Dakota versus Quill, we have to mention this because this is the United States Supreme Court case that was the law of the land since 1992. That South Dakota actually overruled and redefined what physical presence was defined as. So Quill did not have a physical presence in North Dakota. They operated without employees in North Dakota, no inventory in North Dakota. They were simply selling equipment using marketing tactics. If you can even remember these days of direct mail and catalog advertising. So in this case, North Dakota argued that Quill had established a physical presence due to these activities, along with floppy disks that were holding software provided to North Dakota customers. And at the end of the day, the Supreme Court of the United States concluded that since there was only contact by mail only, that it lacked physical presence and the obligation to charge, collect, and remit sales taxes. So that was overruled again in the South Dakota case. But to go back to the physical presence definition of what we were operating under for the last 25, 26 years, it was something as simple as having an employee in the state, having a salesperson soliciting sales in the state, having inventory in the state, or paying for a third party to host your inventory, conducting business, rendering services, or hiring local third-party businesses on your behalf. These are examples of the traditional physical presence state sales tax creating activities that are now simplified, or at least we think it's simplified with the South Dakota versus Wayfair case. So a quick summary here. This was a Supreme Court case where Quill was overturned. This was decided in the summer of 2018. And South Dakota, what triggered this, South Dakota passed a bill in 2016 requiring out-of-state retailers to collect sales taxes. So at the end of the day, when large companies failed to comply, Wayfair, specifically South Dakota, filed a lawsuit, went through the appellate process, and according to the Supreme Court opinion, they really hung their hat on in the changes in technology and the customer sophistication, and they simply said it was unwise to delay any reconsideration of the United States Supreme Court decision on Quill. Additionally, South Dakota does not have an income tax, so therefore it relies heavily on sales taxes. And if anyone does business in South Dakota and you did any sales tax research, you'd be shocked at how many services and other items that typically aren't subject to state sales taxes, they are taxing. So at the end of the day, they ruled in favor of South Dakota, very highly anticipated case. And again, they concluded the physical presence nexus was unsound and incorrect. So the billion-dollar question here for everyone is, do you have to charge, collect, and remit sales tax? And it's very simple. Sales tax is no longer based off of the physical presence rules that we're so accustomed to following. And it's become simply, if you're an out-of-state seller and you're meeting minimum standards, now you need to charge, collect, and remit tax on anything that you're selling that is taxable. And some of these state rules are even carved out to where you need to register, file a zero return, and remit zero taxable sales. In South Dakota, along with many states, the threshold is $100,000 in sales or 200 transactions over a 12-month period. Now, I won't get into too much detail on the transactional threshold. This was in place prior to the Wayfair decision. So now that the states got what they wanted, they're really letting this go by the wayside as they're focusing solely on primarily on the $100,000 sales threshold. So hopefully that was a quick but quality summary on the Wayfair case and how we are to where we are and what are the state's reactions to date. To take a look at this map, out of the 45 states that impose the state sales tax, as you can see, they moved pretty darn quick from last summer to get all of these state sales tax economic nexus rules enacted. So these are all enacted in the light blue colors. And if you notice, only 2 states do not have active legislation, but it is in the process. So at the end of the day, if you're selling outside of your home state in any fashion, absolutely take a look at the $100,000 sales threshold and act accordingly.
And Shane, if I could just add, just real quick there, that's not just selling products, right, out of state, that's services as well.
Yes.
While the services traditionally haven't been subject to sales tax, we have to pay attention to that.
Yeah, and on a side note, for lack of time, I'll try to make this quick. A lot of services that are typically not subject to tax, they're rewriting them as taxable. However, I would be aware of what you're selling. A lot of businesses are selling products, but with that product is accompanied with a service. And you really need to understand the breakdown of the product versus the service is either and or both subject to tax or one or the other. It's a very important thing that's often overlooked. And a lot of service-based companies that if you're getting into any kind of construction type work or hands-on work or inspection services, that's when it starts to get a little trickier on the state sales taxability of those services. But going on to a quick bullet on the state reactions to date. As I stated earlier, 43 states are now enforcing economic nexus. So only 2 states are yet to actually enact and enforce, but I'm sure that will change very shortly. Something to think about, and I get this question often, these are all being imposed prospectively, so no states are imposing any of these taxes retroactively. So you only need to worry about 2018 and forward. Again, the trend is definitely toward out-of-state sellers, and they want to invest and protect their in-state sellers, their in-state companies, I should say. Like I said, complete and total access away from physical presence, so be aware of the sales thresholds at all times.
So with that, we'll have our final polling question of the day, and we're just curious how many of you, if any, have had your door knocked on yet by any of the states? Are they sending questionnaires to you regarding Nexus and whether you have a presence there?
All right, I'll go ahead and close this one quickly so we can wrap up here. 87% said no and 13% said yes.
Okay, so jumping right into post-Wayfair compliance, what do you do? And this is a very a tried and true approach here that we use at our firm for any clients that need this done. First and foremost, you have to have the Nexus study, the Nexus determination done, and that's a matter of what are your activities, past, present, future, understanding the rules, where do you have Nexus, or a fancy word for saying state income tax, state gross receipts tax, state sales tax. From there, you quantify any corporate income that you may have. Then you go to the sales tax side. What are you selling, and what state rules impose sales tax upon those sales? And then from there, do we need to go to customers to collect exemption certificates? Once it's said and done, you can quantify the exposure by state, so you know exactly what your each state tax exposure is. Then the mitigation and disclosure portion, which I highly recommend. These voluntary disclosure groups are excellent to work for. They're pro-taxpayer. They limit your look back, So if you have a lengthy years of exposure, let's say 8 years, it'll limit your look back typically to 3 years, along with a full abatement of penalties. So strongly recommend that. Once you get on the other end of the voluntary disclosure program and now you're filing your returns, here on the sales tax side, there's plenty of sales tax automation engines that can help you calculate, collect, and remit sales taxes. If you're looking for recommendations, please reach out. We have partners that we work with frequently. So this is A to Z on how do you get in compliance after you understand the Wayfair rules and the implications on your business. Made it seem very short and sweet. It's probably not short and sweet due to the amount of research and items that you need to go through, but I strongly recommend that anyone on the call now at least spend some time taking a look at this. And then we can close here on, again, a topic I like to bring up a lot with our privately held businesses, our privately held clients. If selling your business is on the horizon, is it a year away? Is it 3 years away? Is it 5 years away? These become mandatory tax planning solutions, and it's not simply just ideas throwing in the air. As stated earlier, the buy-side due diligence teams are becoming more and more sophisticated, and this is just simply on their checklist to do a state and local tax review. Is there exposure? Do we need to incorporate that into our purchase price? Does there need to be an escrow set up? And not to mention, again, the private equity firms are including this if they're on the buy side. So it's something you need to do prior to selling. Sooner the better, of course. The longer you wait, the more tax, the more interest, the more penalties continue to accumulate. So one more note to leave you with, the Wayfair spillover by state. And what I mean by that is the Wayfair case was only state sales taxes. There has already been spillover to the corporate tax side on how economic nexus is now creating an income tax filing obligation. So it's already spilled over into the corp tax world. As you can see, I have 2 slides of changes from the income side, but you'll also see new changes in the franchise and gross receipts tax world. This is simply a direct result from the Wayfair decision, and now it's spilling over onto the income tax world. So next year at this time, who knows what is in store for us, but I'll just leave you with, this is constant change. It's coming fast and furious. So stay in tune, stay up to date, and if you ever have a question, just please reach out to Tom or I anytime.
Well, thank you, Shane. And certainly as we conclude here today, we would encourage you to send any questions you have our way. We know we went through this pretty quickly. It's a lot of material. But I think the theme we'd like you to walk away with is we're not anywhere close to tax simplification. That's such a myth. Both the Tax Cuts and Jobs Act and Wayfair are extremely complex. I look to Wayfair and say that while there's some similarities state by state, every state's really free to make their own rules. And as you know, our business worlds become smaller and our product or our services go across state lines, we have an obligation to stay in touch with those rules. Because I can't emphasize enough one of the last points Shane made. I've been through that due diligence process with clients who are looking to transition. And I'm not always talking about huge clients, clients that do just a couple $1 million a year in revenue, that those owners are looking to move on into retirement. The firms that are buying them are looking beneath the covers, and if they're finding that these provisions weren't taken care of and your house isn't in order, it can really impact what you think your business is worth. So planning is certainly essential. Wayfair is certainly here to stay. I think you're going to see the states be more and more aggressive. The Tax Cuts and Jobs Act provisions might not be here to stay. They may be short term, so we may have to take advantage of them while we can. So what you don't know can hurt you. Certainly the old I'll comply with it when they catch me is not a good approach. The technology is much greater at the federal and state level. They're using AI and analytics and all that to figure out who's not in compliance. So, it's one of those, you can pay me now or pay me later. So be proactive, work with your professionals, get on the right path, And we certainly, again, thank you all for joining us today. And we look forward to your questions, and we will be in touch. So thank you and have a great day.